I'm Lisa Abramowicz. Welcome to Bloomberg Money Undercover, a show that provides valuable insights into alternative investments. We take you inside the world of private debt, equity, and real estate. Well, let's get straight to those burning issues in private markets. KKR stealing loan business from Wall Street as the banking battles continue. Plus, big banks trying to win over Silicon Valley wealth as startups create a new wave of millionaires. And we talk distressed debt investing with Nick Pappas, head of credit at hedge fund firm CQS. Well, let's get into some of these burning issues. With me, Bloomberg Sonali Basak, Lisa Lee, and Kelsey Butler. Let's start with Sonali. KKR increasingly plowing into loan banking. How much business are they winning away from Wall Street?
Think about it. Just in 3 years ago, they weren't even among the top 20 in this business, and this is new LBO loans. And so now they're among the top 10, where we're seeing a lot of established players like Morgan Stanley and Jefferies lose a little bit of share in the same market.
Okay, leveraged buyout loans, the new ones. This isn't a huge part of the overall business, but they're not alone in trying to sort of get into Wall Street's business. We recently caught up with Jim Zelter, co-president and chief investment officer of Apollo Global Management's credit arm. Take a listen to how he was talking about their heft.
It's all about picking your industries and having an origination business that really is unique in terms of your ability to be not only scalable, but to be flexible and to really understand the ins and outs of various opportunities. So, you know, from our business, we've brought on the expertise. We have the scale, not only in the mid-market, but now in the large cap area, which makes a big difference.
They're talking a little bit like a banker, Sonali. How are they competing with business that used to be really dominated by Wall Street?
Funny you say that. Jim Zelter was a former banker. He used to work at Citigroup, and so he knows how the whole thing works. What Jim has always believed is that you should really know what's in the loans. And so Apollo itself does tend to underwrite and try to originate a lot of their own loans themselves, so they kind of know how the meat is made, and they have more control over the process. It helps them lose a lot less money. That's the idea here.
But they're increasingly lending directly to companies with loans that are $1 billion, $1.8 billion in size, correct?
Exactly. The idea is from like Apollo has more permanent capital than, say, a bank where they have depositors, so they're regulated in a different way.
All right. Meanwhile, when we talk about scale, let's talk about pensions and what they're doing with respect to direct lending. Lisa Lee has the latest on CalPERS, which is the biggest public pension in the U.S. They are starting to look at possibly going into direct lending. The surprise to me is what took them so long?
I know, right? The private debt market has been booming, and more U.S. pension funds are in it than ever before. And CalPERS is really late to the game. And they've been retooling their portfolio as part of their new strategy, as they have a new CIO, Ben Meng. And he said, let's look into this. We haven't done it yet, but it should be part of our portfolio.
Is it too late?
It does seem a little bit that way. There's a lot of money in CalPERS, and for them to move the needle, they have to deploy a lot. They've already had troubles meeting their 8% target for private equity. So are they going to be able to deploy capital when everyone else is getting into this field? It's a question.
So the fact that they've had trouble meeting that 8% target with private equity and actually completely getting that allocation up, what does that say about their ability to get the returns that they need at this point? Do we have a sense of how they're doing or kind of what the outlook is?
So far, they've been doing okay, but when you look at private equity pensions in general, they're meeting like 5.6% returns in the last 10 years, and the assumed rate of return is 10%. And they've all flooded into the private debt markets and private equity markets to bridge that gap. And now CalPERS is looking for direct lending and private debt to help them as well.
I'm sure that there are plenty of managers that are looking to help them out in that space. Meanwhile, scale reigns supreme. Also, with more mergers in credit land, Kelsey has the latest. Kelsey, what are you looking at? Nuveen?
Yes, so Nuveen decided to move its junior capital unit under the Churchill Asset Management umbrella, which is its direct lending arm. And what that really means is now Churchill is going to be a $21 billion player in the private capital space. It's going to be investing in middle market borrowers across the spectrum.
So what's the advantage here to have all of these under the same unit? I mean, is there some sort of economies of scale? Is there some kind of communication? Is there some kind of change in the industry that led to this?
Yeah, definitely. So in this situation, it's a point where bigger is definitely better. Direct lending has gotten so competitive that unless you're able to write really large checks, you're not going to really able to secure deals. Another piece of the puzzle is that the Nuveen group that's moving over is an investor in private equity funds themselves. So what this does is it kind of deepens the relationships between Churchill and the private equity sponsors it's trying to get deals from. It means those phone calls are going to keep coming, and being that Churchill is really betting on the sponsored middle market space, having those relationships is everything.
Kelsey Butler, thank you so much. And to all of our reporters, we really appreciate that. The concept of scale looming supreme brings us to my next guest, Scott Bluestein, Hercules Capital Chief Executive Officer and Chief Investment Officer. Hercules Capital is the leading and largest specialty finance company focused on providing senior secured venture growth loans, not equity, loans, to high growth, and has reached a $10 billion milestone. Scott, thank you so much for being here. When we talk about scale in venture equity, people talk about it sometimes with some concern when it comes to what we've seen certainly out of SoftBank. How does scale help or hurt you in your business?
Sure. So Lisa, scale is a key differentiator in the venture debt part of the market. And the reason for that is it's a very difficult direct lending business to scale. If you think about most direct lending businesses that are focused on sponsor finance or cash flow positive lending, the duration of those loans tend to be anywhere between 3 to 5 years. The duration of the loans in our credit book over a 15-year trajectory is about 18 months on average. So the capital's turning at a much higher rate, which makes it a more difficult business to scale and grow. And then secondly, one of the key competitive advantages that we have is that we've achieved scale. You mentioned the $10 billion cumulative commitment mark. That gives us essentially the ability to pick and choose the deals that we want to do and that we think we should do versus that we think we have to do to grow the business artificially. Really?
Because I feel like if you've got that much money, don't you feel like you have to deploy it and deploy it quickly at a time of really high valuations?
Yeah, so I think another thing that differentiates Hercules Capital is that our model is internally managed. So we're not an external manager where you have that incentive to continue to grow your asset base at all costs because you're earning incentive fees or management fees. As an internally managed BDC, we're actually able to focus on credit. Whether we grow in a quarter or actually don't have growth in a quarter, it really doesn't impact the overall profitability of our business.
All right, so where are we right now? Are you deploying cash or are you holding it back and selling?
We are. We're deploying capital aggressively. We just announced last week that 2019 was a record year for us. We committed in excess of $1.45 billion of capital in 2019. That was our second consecutive record year in a row. That obviously gave us the opportunity to cross the $10 billion cumulative mark, which we announced, I think, this morning publicly as well.
So what's the advantage to venture debt versus venture equity?
Sure, it's really two things. Number one, it's less dilutive. So if you think about a management team, you're the founding CEO of a technology or a biotechnology business, you're quite confident in the trajectory of your business. When you're thinking about how to fund that business, you can go out and raise another round of financing, which is going to be significantly more dilutive, or you can use venture debt or structured debt as a way to extend your runway in a significantly less dilutive manner.
So what do you say to people who look at some of the investments? I'm looking at DoorDash, for example, as being very popular and hot, but potentially valued at more elevated levels than where they can realistically IPO. What do you say to them when you talk about, what kind of equity cushion you have for your debt investment?
Sure. So the interesting part of our model is that we're underwriting our loans at a loan to value of roughly 20%. So if you think about what venture debt is, it's not replacing equity capital. It's actually supplementing equity capital. So if one of our technology or life sciences business is going out to raise $100 million of equity, we're not going to replace that $100 million. We're going to supplement it with $20 or $30 million of structured debt. If you think about that over the life of our portfolio, most of our companies have hundreds of millions of dollars of invested capital, so there's significant equity cushion beneath us in the vast majority of our loans.
Don't you have a lot of competition?
Actually, we don't. It's certainly a competitive market, but it's a specialized part of the market. Direct lending in and of itself is a massive market opportunity, the vast majority of which is in lower middle market, upper middle market, or middle market. Venture lending is a pretty esoteric, specialized part of the market. It requires significant domain expertise. It requires an achievement of scale from a performance perspective, and there are very few people who have been able to achieve what our team has been able to achieve.
You said that you've gotten 12% annualized returns, more or less, and I'm wondering going forward if you think the returns will continue to be at that level.
Sure. So we have publicly reported core yields of between between 12 and 13% over the last several years. We had a little bit of deterioration in our core yields in 2019 as a result of the 3 Fed declines from a rate perspective. We feel pretty confident that we're going to be able to maintain our core yields in a consistent manner with what we've been able to do historically.
Scott Bluestein, thank you so much for being with us. Scott Bluestein, Hercules Capital Chief Executive Officer and Chief Investment Officer. Coming up, Nick Pappas, head of credit at hedge fund firm CQS. He is this week's power player and discusses his approach to finding distressed assets in an era of notably high valuations. And one of our past power players, Oaktree Capital's Howard Marks, spoke out this week about direct lending. He told Bloomberg that too much money has rushed into the space and it could signal trouble ahead. Take a listen.
We, as lenders, are better off because that's a bunch of competitors we don't have. But you know, if people hear, oh, direct lending is great because the banks are inactive, if too much money rushes in as a consequence and tries to invest too aggressively, then that's bad news.
I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Now time for Power Player, our look at some of the most notable names in private markets. I recently caught up with Nick Pappas, head of credit for hedge fund firm CQS, which manages about $20 billion. His perspective on distressed investing is especially interesting at a time of fairly little widespread distress. How does one go about finding substantial returns in debt at a time of broad central bank stimulus? Nick talked about where he finds buying opportunities and started with non-performing loans in Europe.
Less so than in 2011, but the difference now is if we go back 10 years, just post the global financial crisis, the markets were much smaller. So combined global high yield and loans has more than doubled in size since the financial crisis. So right now, in a low default environment, $100 billion, a low default environment being, call it 5% if we include debt exchanges and defaults, that's creating $100 billion of new distressed product every year, just in this environment. And it goes up exponentially if we had a downturn in the economy.
So how close do you think we are, considering the fact that you do due diligence on company balance sheets regularly? How close are we to some sort of downturn like that?
The downturn? Look, I think near term, the market's okay. Last time we spoke, the thesis I have is exactly the same as it was in November. I think central banks are very accommodative. Fiscal policy is very easy. I think growth is okay. I think if anything, growth is on the mend in both Europe and China. I think it's troughed and improving. And markets tend to not trade off. They don't go down when growth is low but slowly improving and fiscal conditions are very easy. Markets tend to hold and we tend to have a risk-on environment, which is good for credit. So I don't see anything on the near-term horizon, but I think longer term, if we just look at credit, even if we don't have a meaningful recession or any sort of downturn in the economy, because of what I'd mentioned earlier, because of the credit market doubling in size, there are just so many more opportunities. They're so sensitive to a downturn. The other thing that's happened since the financial crisis, 2009, average leverage on a deal was 3.99 times. It's now 5.2 times. Covenants at the time, 14% of deals were covenant light. Now it's 83%. EBITDA adjustments are all-time record highs. So that in itself can create a large distressed credit opportunity.
Which industries do you think are most vulnerable to some sort of pocket of distress?
Look, I think we've seen it in oil and gas, we've seen it in retail, but that's more old economy. Or I'd call it mature to old economy, but I think we're seeing it across everything. I mean, something like a Servitech is an operational error.
Just the glut of money coming into these types of strategies.
Yes.
How do you source these deals at competitive valuations or things that look attractive given how much money is coming into the space?
I think there's been a paradigm shift where the selling that we're seeing is so extreme versus what we had seen in prior regimes. So, for example, in the global financial crisis, it was more of a macro sell-off. Now we're seeing extreme selling, and I think it's because passive management doesn't have the resources or expertise to either work out deals or follow their money. Because it's low fee, if you think about it, low fee, they don't have distressed workout teams to work out the loans and don't have the capacity to follow their money. And what we're seeing now is if a company has a liquidity issue, a disproportionate amount of the economics is attached to that new money component, therefore diluting the old money, the old debt. Therefore, we're seeing much lower recoveries because of that. So I think following your money is very important in this market, and that's having and that's creating the selling. So if passive management hears the word restructuring, default, liquidity event, covenant breach, the sell button is just getting hit nonstop, and that's creating the opportunity for us. That's creating lots of dispersion.
That was my conversation with Nick Pappas from CQS. There has been a growing groundswell of discussion about the potential opportunities to come if the economy falters at all. A lot of people looking at the BBB rated sector, the lowest ranked investment grade debt. The volume of total debt in that sphere has more than tripled over the past decade, with companies going in and raising money at the cheapest borrowing costs on record. There is a concern if they get downgraded to junk, a lot of investors will be forced to sell, particularly passive investors, as Nick was talking about, creating some real dislocations that for some may be opportunities. Coming up, wealth advisors are reminding clients of the looming political uncertainty toward the end of this year. We discuss their advice to families who own businesses next. This is Money Undercover on Bloomberg. I'm Lisa Abramowicz. This is Bloomberg Money Undercover. Well, the Bay Area's growth in technology has created a new pool of millionaires, and big banks want in, but there is a culture clash between Wall Street and Silicon Valley. Here for more is Bloomberg's Sophie Alexander, who's written a story on this. And Sophie, joining us from San Francisco, can you give us a sense of just how much wealth has been created by Silicon Valley's creations and, where that money is going?
Yeah, so it's pretty unprecedented, the wealth creation that's coming out here, because all this venture capital money, all these IPOs that have been happening recently, so much of it is happening right here in the Bay Area. So we're talking billions and billions of dollars spread across tons of different people. We're talking about thousands of new millionaires and, handfuls of new billionaires as well.
So, of course, Wall Street's salivating, thinking we can manage that money. How much are we seeing a flood of Wall Street types heading to San Francisco to try to lure these clients or potential clients to their services?
Yeah, so we're seeing a lot of these banks, they're expanding their teams out here to try to capture some of that wealth. We're seeing it with JP Morgan, Deutsche Bank, Morgan Stanley, and so that comes in the form of new bankers trying to attract new clients and just expanding all the resources they have out here.
How successful have they been?
Well, it's hard to say so far. They're up against a lot of RIAs, or registered investment advisors, so they're sort of the upstarts of the wealth management world, and so it's kind of difficult for them to capture that in a place where there's so much, upstart culture, upstart mentality, and so a lot of people are flocking to them as well.
Well, Sophie, that's what I was going to ask. I mean, if you have a startup, how much do these founders and participants want to reinvest in other startups or invest in other kinds of ventures?
Yeah, that's actually something interesting that I talked to a lot of these bankers about, is trying to get these young tech people whose wealth came from startups to not only invest all of their money into other startups, because that's what they're inclined to do, but to sort of diversify their portfolios and, try to make it safer.
Well, thank you so much. Bloomberg's Sophie Alexander joining us from San Francisco. We appreciate that. And sticking with wealth, families who own businesses are getting a piece of advice this year. Sell. Bloomberg's Ben Steverman here with us to explain more. Ben, interesting, when you wrote this story and I read it, I thought, wow, if you have these wealthy individuals being told to sell their businesses by advisors, that screams market top. Is that the correct interpretation?
Well, it certainly could be the market top. We have really no way of knowing, but 2020 is going to be an interesting year for a lot of other reasons. First of all, you have a ton of buyers circling, so these companies are getting great valuations. And if you are a baby boomer who's built their business over their whole lifetime and you're ready to check out, you might as well do it right now while conditions are really good. The other thing that's coming down the pike is a potential for political change. And taxes are a big factor in selling a business, and all the leading Democrats are talking about raising taxes especially on capital gains, which would be the main tax that entrepreneurs paying when they're selling their business.
Is there any way to quantify how much more advisors are asking wealthy individuals to just think about selling their businesses?
This is very anecdotal. I'm just hearing, and honestly, like, the taxes is probably less a driver because it's really hard to get people to make a decision based on future taxes, and the 2020 election seems very far away. But there really are a ton of baby boomers who own businesses and need to be checking out at some point, and they all have, a lot of them hope that their kids are going to take over. But when I talk to advisors, they continue to say the kids aren't interested. It's hard to break it to our clients, but the kids aren't stepping up. They have their own careers. They have their own interests. They're not interested in mom or dad's mom and pop shop.
All right, I'm smiling because I'm thinking of all these bankers going to their clients and saying, he's good for nothing. He's not going to necessarily manage it. It's time to sell. I wonder how much this is stemming from so much money that's coming into all of these funds that need a place to park. And these advisors saying, look, we've got both sides of the equation here. Hey, you client, just sell your business, and then I can put these two together.
Yeah. You've got private equity knocking on the door. You've got all these new family offices being started by billionaires and other wealthy folks, and they're all out there looking for deals. And a lot of these inquiries are coming into these wealth advisors and these investment banks.
Do we have a sense of how many more wealthy families are choosing to sell these businesses?
We really haven't seen an uptick in the data yet. And what I'm wondering is if what I'm being told is that if there's things happening, behind the scenes. It takes a long time to sell a family business. It can take a year or more. And what I'm really interested in is 2020, November, there's an election, and if Trump loses and Democrats come in with strong majorities and they look like they're ready to raise taxes, what does that do to deal flow at the end of the year, especially when we're talking about these kinds of deals?
Yeah, we're talking capital gains taxes here. Thank you so much, Ben Steverman of Bloomberg News. Thank you so much for being with us. Speaking of big money, time for this week's big number. China cleaned up about $290 billion of non-performing loans last year. That's according to the country's banking regulator. At the same time, China's pledging to provide more credit lines for small private firms. That said, there still have been an increase in defaults with a record volume of Chinese corporate defaults last year. So remains to be seen whether or not we can actually stave that with the additional stimulus. That does it for us. Reminder, you can watch us each Tuesday at 1 p.m. New York time, 6 p.m. in London, 2 a.m. in Hong Kong. This is Bloomberg.